Good afternoon and welcome to our third quarter Market Insights webinar. Consistent with past webinars, we would like to share with all of our listeners what we saw over the course of the third quarter. Additionally, we would like to share what we're watching for as the year 2025 wraps up. Before we get started, the usual housekeeping items. Our content will fill most of the hour this afternoon, but if you do have questions, please submit them using the Q&A feature. We will do our best to cover questions that do come in within the hour time frame of this afternoon's webinar. Today's webinar, like others, will be recorded and uploaded to our YouTube channel. So if you are so moved, you can go back and rewatch it or share it with colleagues. As a way of introduction, my name is Greg Leonberger. I'm the Director of Research here at Marquette. If you have joined us for previous webinars, you have heard my voice. I host the webinars. I will cover the U.S. economy. I'm also pinch hitting on private credit this afternoon. Frank Valli and James Torgerson will cover fixed income. The equities section will be reviewed by Catherine Hillier and David Hernandez. Alternatives portion of today's webinar will be covered by Evan Frazier discussing hedge funds, Dennis Yu, who will review real estate and infrastructure. Amy Miller will cover private equity, and I'll wrap it up with private credit. We'd like to start with the U.S. economy. We'll do so again today. The primary headline right now as relates to the U.S. economy, at least based upon a lot of things we read and we get questions about from clients, is the government shutdown. The government shut down on October 1st. Today is October 22nd, excuse me. The shutdown is 21 days now, second longest in history. To this point, we have not seen a lot of ill effects on financial markets. I do think that as time goes on, if this government shutdown persists for weeks and weeks, you may start to see it show up in the fear of some concern across financial markets. But right now, things have more or less been operating smoothly. We look at one of the bigger picture items we follow in terms of economic health is GDP growth. The good news is that GDP grew at 3.8% in the second quarter. Forecasters expect this number to tick up a bit in 2026, at least partially on the back of future interest rate cuts we will see through this year and perhaps into 2026. Now, that's the good news. One of the things we're monitoring, though, in terms of headwinds for the economy is what's going on in the labor market. In September, we saw the second month of companies reducing payrolls, and private sector payrolls fell by 32,000 in September. And this was at least part of the reason that the Federal Reserve cut rates and has continued to cut rates more, expected to cut rates more in 2025. So certainly the labor market, it's bad for consumers because that means that the people are losing their jobs. They have less money to spend on consumption. As we all know, consumption is the primary driver of GDP. So this is worth watching as the coming months play out. Now, that's a quick take on the economy and what growth looked like and one of the perhaps trouble spots going forward here. But as we switch over to financial markets, we're going to start with fixed income. And at the beginning of 2025, our guidance to clients was that fixed income was very likely to be positive across sectors in 2025. We've seen that to date. So Frank and then James, I'll let you guys take us through this section.
Thanks, Greg. So fixed income performance has been strong through the first three quarters of the year. The Bloomberg aggregate is up 6.1%. Coming into the year, the starting yield was 4.9%. So how did we get to that difference between 4.9% and 6.1%? So the first bit is going to be lower base rates. We've seen the 10-year Treasury decline from 4.6% at the start of the year to less than 4% today. In addition, corporate credit spreads have tightened inside of 80 basis points. More broadly, spreads came into the year very tight, and today they're even tighter. So the high yield index has returned 7.2% this year. Loans, 4.7%. That's a little bit less because Fed cutting rates has been detrimental to that asset class. And EMD is up 10.7%. The gold star so far this year has been local market EM debt. Between Fed cuts and trade policies weakening the US dollar, that index is up 15.4% year to date. The front end of the Treasury curve continues to fall after the Fed made its first cut in September, after being on hold for much of the year. The market is pricing in an additional 2 cuts in 2025. Those Fed cuts, as well as back-end pressures, have brought the term premium back into the fixed income market. All in all, fixed income yields remain solid. The aggregate yields are well above average at 4.4% today. Historically, the historical average is only 3.3%. Most other markets are at or near historical averages. The one outlier is going to be high yield. Today's spreads are at 6.7%, where historical averages are at 7.6%. And the reason for that under yielding of that sector is that the spreads are trading absurdly tight. Right now, spreads within the high yield market are at 270 basis points. The historical average is near 500 at 489 basis points. Looking forward, in most scenarios, fixed income should be expected to have a positive total return. If nothing changes in terms of interest rates, and by interest rates, I mean treasury yields, by treasury yields or spreads, you should earn a yield over the next year of 4.4%. For there to be a losing scenario within fixed income, you'd either need to see spreads widen 75 basis points or treasuries move 70 basis points higher. This next slide is kind of the proof statement of the prior slide. When you look at the starting yield of the index and compare that to 7-year forward-looking returns, there's a very high correlation between the two. Over the long term, the starting yield is going to be your primary driver of future return. Now, James is going to walk you through some of what we're looking at in the spread markets.
Thanks, Frank. So Frank did a good job touching on the strong performance in fixed income this year, but I think it's helpful to maybe take a step back and look at a bit longer term performance. So since hitting a bottom in the fall of 2022, fixed income has experienced the bull market across sectors, particularly in the credit markets. I mean, this bull market has been driven by elevated starting yields, spread compression already mentioned, and this has resulted in attractive total returns. So Frank showed a great slide on the previous slide that current starting yields are a great determinator of your future returns. So current starting yields right now still offer attractive carry, and and also there's a possible tailwind from falling base rates. So this presents a scenario where the fixed income bull market continues over the near term. Frank mentioned this as well, and you're probably sick of hearing it from us, but the beat goes on for credit spreads. U.S. corporate bond spreads reach levels not seen in 27 years, and again, spread valuations remain very rich across sectors. With a high demand for credit and yield, spreads could remain at tight levels for an indefinite period of time. And not to continue to bore you with the spreads are tight narrative, but I'm going to anyways. Focusing specifically on high yield here, where spread valuations are at all-time tight levels, we can give a bit of an added context to some of the reasons for continued spread tightening. So there's been a large amount of issuance in fixed income, but there has been a dearth of what we call net new issuance, particularly in the below investment grade markets. This means the new issuance the market has seen has been driven by refinancings and repricings. This creates a scenario where investors and managers are continually seeing and picking over the same bonds, companies, and deals as they come to market to refinance and reprice, and this drives these spreads tighter. However, we have seen a bit of an uptick in M&A activity as of late. This could create more opportunities as a result of an increase in true net new issuance in these markets. But regardless of tight spreads, fundamentals are solid, but you still should warrant some caution moving forward from a spread perspective. So defaults. Always get a hit in the outlook for defaults, as there's been some recent high-profile ones that have made headlines across, your Bloomberg, Wall Street Journal. Well, these large defaults have created headlines. Looking under the surface, defaults still remain muted across leverage credit. Loan defaults, in addition to liability management exercises, continue to moderate, while high-yield defaults remain near all-time lows. On a go-forward basis, defaults are not expected to increase materially. However, there are pockets of stress in some of the lowest rated issuers, and there is the possibility of unforeseen risks on the horizon. So this is not a perfect predictor, but Fed hiking cycles have often preceded or coincided with an increase in defaults within leverage loans. So we just touched on the muted outlook for defaults, but given those headlines mentioned around some higher profile headline grabbing defaults like First Brands, it makes sense to drill down a little deeper here. The prolonged higher interest rate environment has put added expenses on loan borrowers' balance sheets. This is something worth monitoring if the economy begins to slow. However, Fed cuts should help ease interest expense for these borrowers. Additionally, fundamentals in the majority of the loan market remain on solid footing, and despite these headline grabbing defaults, overall those should remain idiosyncratic. Then finishing up here with opportunities and risks. So on the opportunity side, income generation. So don't worry, bonds are still back. We just wanted to change up the wording to keep things fresh here. So as we've talked about throughout the fixed income section, starting yields have come down, but fixed income still provides attractive income accretion potential. More often than not, your starting yield is roughly what your forward return will be. So this dynamic presents a scenario that continues to fuel solid total returns while still providing a cushion to the downside. Additionally, tailwinds from Fed easing. With the initiation of the Fed's next stage of this easing cycle, a continued reduction in base rates could boost fixed income returns in the short to intermediate term with that tailwind from falling rates. If rate cuts do accelerate on weaker economic data, fixed income can provide the ballast to an investor's portfolio due to that income potential we've detailed. And finally, a strong outlook for credit. When we talked about defaults, fundamentals remain resilient across credit sectors, and corporate balance sheets are in solid places. This should keep defaults low moving forward. And then on the risk side, so we mentioned this multiple times on these webinars here, but stagflation is still a risk. Rich spread valuations are a risk. I'm not going to rehash this, but spreads are tight, and there's a possibility of spread widening impacting total returns. And then obviously multiple wild cards. So Greg already detailed the government shutdown, but as always, whether it's Trump's swift reversals in trade policy or a slowing job market, there are many possible headwinds and wild cards that fixed income investors will need to navigate.
Yeah, and James, I think the real takeaway is it's been the same message for a while now, that from a value perspective, bonds are expensive because spreads are so tight. That also, of course, indicates perceived low risk in the market. On the other hand, yields are high. Yields are high. It's a great source of income for treasuries. That's a great source of diversification portfolio. So all in all, the outlook for bonds is certainly more positive than negatives as we sit here with 1 quarter left in 2025. Let's move now to equities, and U.S. equities, while not quite keeping pace with their non-U.S. equity counterparts this year, are still up double digits for almost every sector of the market. So Catherine, take us through what you saw over the last quarter and then what you're watching for the remainder of the year.
Great. Thanks, Craig. U.S. equities posted another strong quarter in the third quarter, with major indices achieving new all-time highs driven by a combination of strength in AI-related companies as well as a dovish pivot by the Federal Reserve that others have discussed. At the end of September, as Greg mentioned, most U.S. equity indices saw double-digit returns for the year, exclusive of small cap value and mid cap value. But excitement around AI continues to be what is driving the markets, particularly in growth-oriented sectors, as the Russell 1000 growth outpaced the Russell 1000 value by over 5% in the quarter. Unlike recent periods, though, small cap equities led the market, as the asset class continued to build on strength post-Liberation Day. Following the tariff-induced sell-off that lasted through April 8th, risk-on sentiment helped the Russell 2000 advance 39%, a staggering number that outperformed the 35% return for the S&P 500. We'll focus on the factors that have driven small cap equities in this period in a few more slides. From a sector perspective, we can see here that growth-oriented sectors did build on the strength that they saw in the second quarter, as information technology and communication services led the market. But value-oriented sectors also benefit, particularly the utility space. We can tie this back to the leadership of the perceived beneficiaries of AI, as utilities will benefit from increased electricity demand from the data center build-out and infrastructure build-out that is needed to support AI. And as we mentioned earlier, market indices achieved several new all-time highs in the quarter, but the Russell 2000 might be the biggest standout here. With the market fueled by AI, it's probably no surprise that the large cap and technology-oriented indices, namely the S&P 500 and the NASDAQ, have achieved several new all-time highs since the market pullback back in 2022. But at the end of September, the Russell 2000 reached just its first new all-time high since November of 2021. That's almost 4 years ago, as the U.S. equity market continues to see past the risks of a slowing economy. Although we have seen strength in other areas of the market, the Magnificent Seven are still not far from the conversation. This first chart here may be a bit hard to read, but what it's showing is the divergence of returns we have seen across the Magnificent Seven companies in 2025 so far. NVIDIA, Alphabet, and Meta continue to exceed expectations, fueled by incredible CapEx spend, primarily within the AI sector. On the other hand, Tesla has seen weakness on softer earnings and political noise surrounding the company and its CEO. Even with this divergence in company performance, though, this cohort of companies continues to post strong earnings growth and contribute a meaningful portion to the S&P 500 return, which was at 41%. Now, as we've mentioned, and we're probably all aware at this point, the rest of the U.S. equity market has lagged large caps, but this is tied back to that earnings strength we just discussed among the largest constituents in the market. But many investors may be curious if U.S. equities can continue this march higher, and I think this slide helps support a case for a continued positive performance from the U.S. equity market. Although it's widely accepted that the Magnificent Seven companies will experience and have started to see to some degree a slowdown in earnings growth, the rest of the market may finally be starting to catch up. Earnings growth for not only the rest of the S&P 500 companies, the other 493, but also small caps is expected to improve over the coming quarters, looking out into 2026. This is noteworthy for small caps especially, as this asset class posted negative earnings growth in 2024. As we look forward, more accommodative monetary policy, as the Federal Reserve lowered rates in September, may further support small cap companies given their higher level of floating rate debt relative to their larger cap peers. Despite the overwhelming market strength we've seen within U.S. equities, excluding the Magnificent Seven, the drivers of performance have been marred in speculation. The next several slides will highlight this trend and focus more specifically on not just the third quarter, but the period since April 8th, as the market dynamics that we saw to close the second quarter in June simply just carried over into the third quarter. There may be several reasons for these trends that we'll talk about, including the rise of passive investing, algorithmic trading in the market, and the persistence of the retail investor. To start, we see here that volatility as a factor outperformed, as the highest beta stocks meaningfully outperformed their lower beta counterparts. While this story held true across U.S. equities, it was the most pronounced among small cap equities, which saw a performance dispersion between these two groups of over 53%. If we use profitability as a measure of quality, we'll also see that lower quality companies outperformed post-April 8th as unprofitable companies and companies with no revenues drove returns for the market, especially in the technology sector and among small cap equities. Unprofitable companies in the Russell 2000 outperformed the highest quality companies by roughly 30% in this period. These companies have been tied to specific themes that have attracted significant retail investor attention, including AI, nuclear energy, cryptocurrency, and quantum computing. I might also highlight that the biotechnology industry, which is pretty prevalent among small caps, are largely unprofitable companies, and they comprise a pretty good portion of the 40% weight of unprofitable companies in the Russell 2000. This group outperformed by about 10% as they advanced 48% post-April 8th. So why are these factor dynamics important, and why are we just focusing primarily on small caps? And the answer lies in the performance of active managers. Historically, active management in small cap has paid off, but this hasn't been the case recently. Based on early data, the average active small cap manager meaningfully underperformed the Russell 2000 post-April 8th and in the third quarter. The severity of this underperformance has reached levels not seen since the dot-com bubble and is far below historical averages for active managers. To put some numbers around this, since April 8th, the average small cap core manager trailed by over 9%, with just 9% of managers actually able to beat the index in the third quarter. This, to be blunt, bad quarter for active managers ties back to the factor dynamics we just discussed, as active fundamental managers are largely positioned in direct opposition to what has worked post-April 8th. More specifically, active managers tend to favor higher quality companies with stronger balance sheets and improving margins, and also tend to carry an underweight allocation to the biotechnology sector we discussed that led the market. While this period has been painful, if a market fueled by speculation persists and fundamentals continue to be overlooked, active managers may continue to struggle. I'll also note that although we highlight small cap managers on this slide, the thematic low quality nature of the market we've discussed was challenging across the U.S. equity spectrum as active managers underperformed more broadly. Now, it wouldn't be a webinar without looking at valuations, and given the recent market strength, most of you could probably guess that the U.S. equity market still appears relatively expensive. But if we break this down further within the Russell 1000, the top 10 companies traded a much higher valuation relative to the rest of the market, 31 times versus 19 times for the rest of the market. This implies there may still be some room for U.S. equities if market leadership continues to broaden out on some of the changes we discussed earlier, like earnings stabilization, continued innovation, and the more accommodative monetary policy we're seeing from the Federal Reserve. Now, moving to risks and opportunities, we've touched on most of these throughout the presentation, so I'll summarize quickly. Although returns were fueled by speculation, earnings growth showed signs of stabilizing and improving more broadly across the U.S. equity market, which may be a tailwind to underpin positive performance going forward if fundamentals do in fact come back into focus. Additionally, small caps and growth equities may also see further support from more accommodative monetary policy. And while the market continues to be resilient, primarily supported by innovation and technological advancements surrounding the AI space, several challenges do persist, including elevated valuations and market concentration, as well as a cooling labor market, stubborn inflation, and geopolitical tensions that James also touched on. Additionally, the U.S. government shutdown that's been mentioned that began in October may add a new layer of volatility to the market. So while we're optimistic about U.S. equities going forward, we are still a bit cautious.
Thanks, Catherine. And the concentration risk is something we've spoken to a number of times over the last couple of years, so that shouldn't be new to listeners. I think that the opportunities below the first one, earnings breadth, is really something that could really be broader support for the market, as well as probably provide a boost to active management in the space as well. So that's something we'll watch very carefully in this last quarter here. So let's move now to non-U.S. equities. And David, you covered really eloquently at the symposium last month and talked about kind of why non-U.S. equities has outperformed U.S. So you share some of that insight, not only what's happened, but what you're watching for the rest of the year.
Yeah, and non-U.S. equities continue to perform well into the third quarter. And if you look at the emerging markets index, they had an especially robust third quarter, returning 10.6%. In this asset class, you've seen broad country support, broad country performance within emerging markets, but one of the themes and investment themes that we've seen play out is Asia technology stocks have done well this year. And I'll touch more a bit on that later in this section. Another point to make is that the EFI Small Cap Index leads most non-U.S. equity benchmarks year to date. And this group of stocks has generated good earnings results thus far this year, and that's helped boost returns for that asset class. And I'll have a slide on that in terms of earnings growth in non-U.S. small cap. Now, before we leave this performance page, I'd ask people to pay attention to the middle column there and the year-to-date numbers that are listed here. These are very large numbers. And if we think back at the start of the year, there were question marks around non-U.S. equities and how President Trump's policies might impact them. There are questions on economic growth potential overseas. Then you had tariff news announcements come throughout 2025. So with all that being considered, if you look at these three key benchmarks for non-U.S. equities, the MSCI EFI, the MSCI EM, and the MSCI EFI Small Cap, all three benchmarks are north of 25% for year-to-date performance through the third quarter. So it's been a strong year for non-U.S. equities. Now, these returns that we're seeing are broadly coming across multiple non-U.S. markets. It's not really concentrated in individual countries. And if you look at 12 of the largest countries outside of the U.S., 12 of the 13 largest countries, 12 of them have generated returns north of 20% year to date, and 6 of them have generated returns north of 40% year to date. The standout poor performer this year has been India, and that country has lagged. It is down 2% year to date through the third quarter. And this country has faced some headwinds on a couple of different fronts. First, on the U.S. tariff front, there's a 50% tax from the U.S. across a broad range of products, which has impacted that country. Additionally, some of the earnings growth this year is disappointed from that market. It's also experienced some AI disruptions as it relates to their IT services industries. And they've also, if you look at the beginning of the year, started off the year on high valuations. So all of that has come into play and created a tough return environment for India in 2025. But longer term, many investors still like the growth potential from this market, despite some of the recent headwinds. Now, outside of India, country performance has broadly been been good across several different markets. And I think there's some things we would note in terms of themes that we're seeing for non-U.S. equities. And there's three themes that we're paying attention to and that we note here on this slide. The first is European defense industry. And I talked about this in the first quarter. There's expectations for increased defense spending in that region, and that's boosted returns from that industry and that grouping of stocks. Second theme is European banks. They've outperformed this year, and I'll provide some context on why that is in the next slide. But you've got these first two themes that I've mentioned. These two themes are tied to generally from a sector perspective, industrials and financials. So these tend to be cyclical or value-oriented type stocks. And the third theme to the right is Asia technology. And Asia technology from a theme perspective tends to be focused on growth. So you have many of the AI tailwinds that have positively impacted the US market is also positively impacting areas outside the United States. You have Korea and Taiwan. These are countries that have large exposures to information technology sectors. They have exposure to hardware and semiconductor companies that have benefited from some of the AI boost that we've seen this year. And you also have a country like China, which has exposure to some of those hardware names, but also has exposure to what might be considered a hyperscaler like Alibaba, which is committed to spending $53 billion on AI improvements, as well as has partnered with NVIDIA. So within the non-U.S. equity space this year, there's some complementing themes there within that market. You've got themes that are tied to secular growth and some of what's been benefiting the U.S. markets. And then you have some themes that are tied to cyclical or value-oriented style of investing, which can provide some diversification benefit for investors. Now, on the banking front, the financial sector has been a key contributor to developed market performance this year. It's accounted for 9.2% of the 25% year-to-date return for the MSCI EAFE index. And much of this is being generated from European banks. These stocks have produced improving returns on equity over the last 3 years and have actually started to surpass the U.S. banking sector. We've also seen increased share buybacks, increased dividend payouts. There's also been an increase in M&A activity this year that has led to additional revenue sources for this sector this year. So again, on a sector basis, European financials have been a key contributor for developed markets in 2025. Now let's take a look at key contributors using a different lens. So here we're taking a look at 3 indices, the non-U.S. developed large cap, their emerging markets index, and the non-U.S. developed small cap index. And we're decomposing the returns on 4 factors: currency, dividend, earnings, and valuation. Now, in previous webinars, I've talked about how currencies have been supportive for non-U.S. equities. You can see that in the blue area of this chart. Currencies have added 11% to developed markets, both large and small, and 3% to emerging markets. This is different from most of what we've seen over the last 5 to 10 years, where currencies have detracted from non-U.S. equities. Besides currencies, the second thing I would note is the earnings, which is here designated in the light blue area. And related to earnings, I'd say that there's 2 key stories here for me. The first is that across the 3 indices, earnings have been positive this year. And that is a positive change from what we've seen over the last several years, where earnings growth hasn't been consistently positive in this space. So that is a good thing to see. The second thing that I would note is that valuation expansion, which is marked in the purple area of these charts, has been a larger contributor to performance compared to earnings growth for developed large cap and for emerging markets. The purple area is bigger than the light blue area. However, if we look at developed small cap, the reverse is true. Their earnings growth has been a bigger contributor to returns compared to valuation expansion. So I do think that that is noteworthy. Now, when we look at valuation multiples across these 3 indices, we see that the average multiple down at the bottom of this table is in the top quartile of expensiveness for developed large cap and for emerging markets. And it sits about historical average for developed small cap. So you see that difference there. Again, multiple expansion hasn't been as big of a contributor for small cap as it has been for large cap, as well as mid cap. Now, if we go back to the start of the year, the valuations across all 3 were somewhere between the 50th and 60th percentiles. So we have seen multiple expansion occur within the large cap and emerging market space. And when we think about risk and opportunities for non-U.S. equities, we would note higher valuation levels as being a risk in this market. There's less downside protection that is there should the market sell off here on the next slide, and should there be a market event that can kind of prevent some of the downside protection. So high multiple expansion within large cap and emerging markets we would see as a risk. On the flip side, I talked about earnings growth. It's positive this year, which is a good thing to see. And if you look at projections for 2026, it's projected to be in the double-digit range. So should that earnings growth come to fruition, that would be supportive of non-U.S. equity performance. Two additional opportunities I noted was the diversified themes that we're seeing that are connected to more value-based investing like defense or financials, as well as the growth-based investing with the Asia technology performance that we're seeing this year. And then in terms of additional risk, policy uncertainty is something that we've had throughout the year as being a key risk. We would anticipate that in the foreseeable future that will remain a risk. And then I haven't talked about Japan. Japan did have some new leadership step into that country, so there isn't some uncertainty in terms of economic policies that will come out, as well as trade policies that will come out. Though I will note that the market has recently reacted positively to the change in leadership there.
Thanks, David. And your comment about multiple expansion and how that's certainly been a pop to the markets this year. It's been good for returns this year, but as we've said consistently on these webinars, what you really need is consistent positive earnings growth to support higher prices across equity markets. So the good news is that the outlook is that earnings will remain positive, and something we'll watch for the remainder of the year and into 2026. Okay, so now we're on to the alternatives portion of this afternoon's webinar, and we're going to lead it off with hedge funds. And Evan, you've got a pretty good story to tell again for hedge funds.
Indeed, I do. Yeah, thank you, Greg. So hedge funds continue to chug along quite nicely in 2025, with 3Q seeing positive performance across all major strategy types, as you can see here. So equity-oriented funds, again, led the way, with the HFRI Equity Hedge Index up over 7% for the quarter. That pushes the year-to-date return for that index to over 13%, which is very impressive considering the S&P is up about 15% this year, at least through the end of September. Event-oriented and convertible ARB strategies also posted solid results during the quarter. And then global macro funds, which lagged, you'll recall, earlier this year, saw a rebound in 3Q and are now up about 4% in 2025. As for put right, which we always call out on this webinar at the bottom, up about 4% for the year. It's been a bit of a challenging year for that index. Put right strategies essentially sell at the money put options on the S&P each month and then hold treasury bills to back the potential obligations there. And because of this profile, put right often lags during periods of sharp market movements in either direction. So for instance, the drawdown that we saw post-Liberation Day and also the V-shaped recovery that markets have exhibited over the last 6 months. And while that index is positive for the year, the market environment over the last few quarters has not been the most conducive to relative performance for put right. So that space notwithstanding, the hedge fund asset class continues to generate very solid relative and absolute returns this year. And in the case of some of these indices, actually exceeding expectations. So this chart shows how strong long-short alpha generation has been so far this year. So the top 50 crowded long positions have outperformed the S&P 500 by 1,500 basis points since the start of the year. And that has led to very strong returns for equity-oriented managers that we detailed earlier. This is actually the best first 3 quarters of a year for long-short alpha generation in a decade and a half. And pretty much all of this, again, is being driven by the long side. As you can see, the top 50 crowded shorts are actually slightly outpacing the S&P 500 since the start of the year. So the upshot here is that hedge funds have had ample opportunities on the long side and have positioned their portfolios quite well in 2025, despite a relatively narrow market environment. So here's the VIX futures curve as of 9:30. Spot VIX is actually a little higher now than it was then, but it's still around long-term averages. And you can see the upward sloping nature of the curve as we move, 6-7 months out. But the interesting thing is how hedge fund managers are positioning themselves for near-term volatility. And we'll get a sense of that on the next slide. So hedge funds are increasingly shorting the VIX, essentially betting that market volatility will remain low in the coming months. According to the CFTC, net short positions tied to VIX futures are at highs not seen in over 3 years. This chart, I believe, was actually featured in Greg's quarterly letter that went out today. I encourage you all to take a look at that. But anyway, the belief in sort of lower for longer volatility may further embolden risk taking on the part of hedge fund managers. But it is worth pointing out that this type of positioning may also amplify negative performance for hedge funds if we see volatility spike and strategies get squeezed. Already this month, we've seen a daily move in the S&P 500 of more than 2.5% downward. Today is not exactly a banner day for stocks either. So will certainly be important to monitor exposures at the individual fund level going forward, as hedging and downside protection could become of particular importance for investors in the months ahead. So we've observed a notable pickup in corporate activity in 2025, including more complex situations like activist campaigns. This is data through year end, but 2025 is on pace to see the highest number of public activist campaigns since 2018. We're already seeing these campaigns, and we're seeing them across geographies and different regions, but two worth kind of pointing out here are Japan and South Korea. Those have been key areas of focus for activist investors. Dave has discussed this phenomenon on previous webinars, but there's been a shift in sort of corporate culture in certain Asian countries where management teams are now increasingly being held more accountable for capital allocation decisions. This has helped spur what I would say is a new wave of activism across that region that could help unlock substantial shareholder value across Asian equity markets and accelerate that region's transition to a more globally competitive corporate governance landscape. So we expect this pipeline of corporate events in Asia and elsewhere to continue through the end of the year and beyond, and this could offer a better opportunity set for activist and special sits strategies. So when we think about the current hedge fund landscape, there's a balance between opportunities and risks, as there are with all asset classes, I suppose. But on the risk side, sustained lower volatility and crowded market leadership that we kind of touched on earlier could limit trading opportunities and make alpha generation more challenging going forward. And we've detailed this one before, I believe, on previous webinars, but the concentration of capital in kind of large multi-manager platforms, pod shops, kind of raises questions about scalability and viability of kind of smaller firms in the hedge fund space. On the opportunity side, we discussed kind of long alpha generation and the activist campaigns that have been positives for hedge funds this year. Sort of a corollary to the activist piece is the overall increase in deal volumes that might lead to tailwinds for event-oriented strategies in general going forward. And then, as always, we like to end by mentioning the fact that hedge funds continue to offer valuable diversification benefits and downside protection for investors. I'm pleased to report that the asset class has largely met or even exceeded expectations so far this year, and let's hope that continues into the future. And so with that, Greg, I'll turn it back over to you.
Yeah, thanks, Evan. If you look at year-to-date returns for hedge funds across the different categories, all of them are positive. A lot of them clustered in the high single-digit positive return numbers. So certainly hedge funds appear to be doing what they're supposed to be doing, is exactly what Evan said. Capital preservation and providing some upside potential. All right, let's move now to real assets. We're going to cover real estate and infrastructure. And Dennis, I'll let you take us through both of these.
Absolutely. I'll start off with real estate. As a reminder, private real estate and infrastructure performance are reported on a lagged basis. So for the second quarter of this year, the NFI Odyssey Index achieved a total growth return of 1%. This was all driven by income and with flat appreciation. We also just received a preliminary third quarter report from UNCRIF showing a total growth return of 0.7% for all Odyssey core real estate funds. Therefore, if we count third quarter estimates, we're currently witnessing 5 quarters of consecutive positive returns. So with further market recovery, we're entering a new real estate cycle as valuation stabilizing and capital return to the space. And one of the biggest tailwinds to support this real estate rebound is declined construction level. On the apartment side, new start has fallen by more than 70% from the peak level, and the number of units under construction is also in rapid decline. A similar trend is observed in the industrial sector, where supply are shrinking after a record wave of development in 22. Shifting to real estate debt market, CMBS issuance volume this year is expected to reach 71 billion. That is fourfolded compared to the number in 23. This marks a significant recovery after muted quarters previously, and this rebound is driven by boosted confidence in lenders and growing investor demand for real estate debt. In terms of sector outlook, we see steady rise in alternative sector within core real estate. Exposure in the Odyssey universe to alternative has increased from low digit to more than 13% today and going forward. This main driver of the trend are persistent demand in data centers, self-storage, senior housing, really sectors with structural tailwinds from demographic shift and technology development. And this takeaway is that core real estate funds are expanding their source of income outside of the traditional big four, and we're expecting this trend to continue as pipeline and platform scale. Looking at the tenant demand on the sector level, what stands out is how much the future growth is expected to come from alternative rather than traditional sectors. Data centers is at the top of the chart, as you can see here, with 11% projected annual demand growth through 29, and senior housing follows at around 3.7%, supported by aging demographics and limited new supply in the US. To summarize real estate, the opportunity in non-core and distressed segments are still pretty compelling, where dislocations and constrained financing have created attractive entry points, which are amplified by the limited supply situation. Meanwhile, sectors and market selection are important given alternative sectors now present strong fundamentals and diversification benefits. On the risk side, the office sector remains challenged. Construction costs are rising due to proposed tariffs and labor shortages. And lastly, the rising 10-year Treasury rate continue to be headwind for valuations as borrowing remain pretty expensive. Moving on to infrastructure, we see a strong 5.5% quarterly return for private infrastructure in the second quarter, with 11.5% return over 1 year and consistent performance over longer periods. This indicates steady and reliable performance for private infrastructure, making it a very attractive option for investors seeking stable income cash flow tied to inflation. In particular, we see significant capital inflow to digital infrastructure in recent quarters, and we expect this momentum to continue in the near term. This chart really highlights how aggressively these major tech firms are investing data centers and AI infrastructure, and the annual capex budget for these hyperscalers will exceed more than $450 billion by 2026. One of the biggest challenges of data center expansion is the demand for power. US data center electricity demand is expected to be more than tripled over the next 5 years, rising from around 200 terawatts today to over 600 by 2030. What is more striking is data centers' share of total US electricity consumption. They currently account for roughly 4%, but the number will jump to 12% by the end of the decade. That means more than 1 out of every 10 electricity produced in the US will be going to data processing and AI computation. To dive deeper into where the power was generated from, this chart breaks down the source of power to meet data center demand. By 2035, US data centers alone will expected to drive the need for 80 gigawatts of new power generation capacity. While renewable energies will grow meaningfully, conventional sources of power such as coal mine and natural gas will remain active as the backbone of new capacity additions. At the same time, we are seeing a steady build-up of energy storage, which is essential to integrate more renewables into the grid. To wrap up on infrastructure, on the opportunity side, infrastructure remains as reliable inflation hedging and income generating asset class. With power demand surges from data center development, there is a growing demand for energy generation and transmission in both renewable and conventional source of powers. On the risk side, GDP-linked assets can be more volatile in the slowdown, and asset quality, operational execution remain pretty critical to long-term success across infrastructure sectors.
Thanks, Dennis. And to circle back to real estate first, at our symposium last month, we touched upon the rise of alternatives and how certain sectors like senior housing and medical offices are really going to drive a lot of the outsized returns on a go-forward basis. And then for infrastructure, certainly the growth of AI and the more need for the increased need for power and the ability to supply power, and even the warehouses for these hyperscalers to build out their technologies is really a nice tailwind for the asset class. Of course, that's balanced by the GDP linked assets. That's usually a pretty consistent return stream, but to the extent we do see volatility in GDP, that could impact the future return streams in infrastructure. All right, let's move now to the last category of asset classes here this afternoon. It's private equity and private credit. So Amy, I'll let you lead it off, then I'll take it home.
Sounds good, Greg. Thank you. So on this slide, we're going to show performance as of 2Q as private equity and venture capital performance is lagged. Global and U.S. venture outperformed for the second quarter in a row. Over the mid and long term, U.S. small buyout, which we define as funds with 1 billion or less in commitments, has continued to shine. Generally, U.S. private equity is still outperforming public markets on the long-term basis, with the exception of expansion stage, which has started to see some upward momentum, albeit pretty inconsistently. As far as private equity deal activity is concerned, value reached over 500 billion in the first half of this year, which is up 28.7% year over year. Deal count hit over 4,400, which is up 8.2% year over year. Overall, the year is tracking towards 1 trillion in deal value and potentially exceeding last year's transaction count, which would make 2025 the second best year on record after 2021. While tariff impacts continue to create some uncertainty throughout the second quarter, the positive trend continued in part due to equilibrium in the credit markets as financing costs have moderated since 2022 great rate hike. Lenders are active again, buyers and sellers appear to be meeting in the middle, and then this is likewise having a positive impact on the exit environment, which is a welcome change from the prior 3 years. Exit value reached 340 billion, and volume hit 732 exits in the first half, totaling a year-over-year increase of 104.6% and 18.3% respectively. The preliminary third quarter numbers show continued positive momentum, which is a welcome reprieve from the dearth of exits in the past 3 years, as I mentioned. If this trend continues, 2025 is on track to easily surpass each of the last 3 calendar years, both in terms of value and volume, and a return to pre-COVID levels with respect to exits. On the venture side, recall my comments on the outperformers for the quarter, which included US venture, which has also been the case on a rolling 1-year basis. We can see these trends in the display graph. Much of the capital flow and valuation trends within venture have continually been driven by investments in artificial intelligence and machine learning, particularly as it relates to later stage businesses with valuations returning to 2021 peaks. On the exit side for venture, exit activity still continues to be muted relative to 2021, which was clearly an anomaly in the past 10 plus years. But 2025 is set to return to historic norms in terms of both deal value and count. The IPO window cracked a bit open in the second quarter with 2 offerings worth a combined 1.2 billion, signaling symbolically important improving sentiment, which may help push exit volume and value for the remainder of the year. From an opportunities and risk perspective, persistent uncertainty continues to create opportunities for those managers with dry powder, but the fundraising continues to experience pressure for those looking to come back to market in the near term. A more robust exit environment may be the catalyst to turn this around in the coming quarters. And AI and machine learning have continued their dominance of the VC asset class. This also may pose as a risk, as it could be an indicator of a bubble with too many dollars chasing the same startups, which may be inflating valuations. The long-term impact of tariffs remains a question mark. However, geopolitical risks have begun to surpass tariff concerns as investors assess their portfolios and consider where to put that new incoming cash from their private equity portfolios. To you, Greg, to hit on private credit.
All right, thanks, Amy. So to wrap us up here, we'll talk about private credit, and same comment for returns, that returns are delayed here. This is the second quarter of 2025. Illiquid markets are just slower to report, and that's why the data is lagged. But I would encourage everyone to look at kind of the 1, the 3, the 5, and 10-year return numbers here in that first row, middle market direct lending, and compare that to the row just below it, Credit Suisse leveraged loan. And this is really the payoff of being illiquid versus liquid. And you're 10.1, 10.7, 10.9 as you go across the 1, 3, and 5-year periods. So you see that not only the premium above kind of your more public market loans, but then also the consistency of those returns. And that's really one of the big selling points of private credit and why it has a place in a lot of institutional portfolios. Now, as we sit here and look forward, I think it is realistic to expect these returns on an absolute basis to drop a bit. And when I say a bit, let's say 100 to 200 basis points, really on the basis of just simply rates are going to be lower as the Federal Reserve continues to cut rates. And then you heard Frank and James talk a lot about tighter spreads, and that tighter spread story is true both in public credit and private credit. So that'll impact returns a bit on a go-forward basis. But if we look over the course of 2025 and what we've seen here, and talking about activity and direct lending volumes, going into 2025, the broad expectation across markets was that there would be a lot of M&A activity, right? A lot of deal activity. The incumbent administration would probably relax some of the regulation across those deals, and you'd see more of it. But then the challenge has been the uncertainty around tariffs and that overhang of uncertainty about tariffs. And because of that, you haven't seen the direct lending volume really hit the number that the market expected going into the year. Now, that said, 4Q data will probably exceed 3Q data in 2025, should still go down as a pretty strong year in terms of overall direct lending activity. But the other dynamic there is that we rewound the clock a couple of years ago and looked back to 2023. Well, you saw most of the transactions taking place in the direct lending, in other words, the private space, as compared to the broadly syndicated loan market in the public space. Now, 2024 and 2025, you've seen a normalization of that activity, and there's a lot of competition between the direct lending market and the broadly syndicated loan market. I think that's good for the overall health of the market, and for those looking to get a deal done, what it's meant is lower spreads. There's a lot of capital chasing less deals than the capital chasing those deals, is similar to the dynamic Amy just spoke to. And because of that, what you've seen of the kind of the range of deals when we're talking about spreads, you've really seen a movement down towards that lowest range of spreads. That's the first column here in the chart, the less than S plus 500 basis points, SOFR plus 500 basis points. In the third quarter of this year, 57% of new issuance sat in this lowest absolute level of spread. So again, that's good if you're trying to borrow money. A little less interesting if you're investing in private credit funds, which are adding these to their portfolios. So again, that's something to monitor going forward, and probably explain a little bit of a somewhat lower magnitude and returns in the market. But I think it's also helpful to remind everyone here that we still see that illiquidity premium. So what we have here is the spread for broadly syndicated loans versus direct lending. And the difference, you see a positive difference in what that spread is. Okay, so there's an illiquidity premium that continues despite the dynamics that we've just talked about. Chad's not here. I can't do full justice to the asset class that he can, but at least wanted to take all listeners through kind of what we see from a value perspective, what we see happening to returns on a go-forward basis here, not only for the rest of 2025, but really looking out into next year as well. The opportunities and risks are pretty straightforward. Some, again, themes that we've talked about pretty consistently over the last few years. We focus on the lower and core middle markets within the direct lending space. Overall, we think that those can deliver attractive risk-adjusted returns. Of course, it's balanced out by the illiquidity risk, default risk, and then as the Fed cuts rates, right, as those base rates come down, that is going to reduce all-in yields as rates are cut. So that's really all the asset classes as we sit here. As obviously it's the end of October here. This data is through September 30th for the public markets, and second quarter for private markets. We'd like to thank you for spending some time with us. Unfortunately, we are more or less right at the top of the hour. If there were questions submitted, we will make sure to circle back with those who submitted those to make sure your questions are answered. We hope this has been a good use of your time. Best of luck to everyone for the remainder of 2025. We will see you in January for our 2026 market preview. Thank you very much.